Good afternoon, everyone, and welcome to our monthly webinar. We are excited to welcome Sipho Dlamini as the presenter today, and he's going to talk on Save Today, Thrive Tomorrow, Building a Resilient Financial Future. Sipho began his career as a paraplanner intern and has never looked back. Today, he is a dedicated wealth manager with a deep passion for people and wealth creation. He holds a BCom in finance and a BCom honors in financial planning from the University of Johannesburg. Please join me in welcoming Sipho as he shares his insights on building financial resilience for a better tomorrow. Thank you, Sipho.
Thanks, Rihanna. Thanks for the intro and welcome to everyone. Maybe we can get started. And these are the items that we'll cover today. Firstly, it's understanding the importance of saving, creating a personal budget. We'll cover also building an emergency fund. What are the things to think about? Investing for the future. What does that look like? Planning for retirement and developing good financial habits. So maybe to get started, we can just maybe look at a South African financial landscape. The household savings in South Africa is actually very low. It actually accounts for 0.5%, less than 0.5% of the country's GDP. And then the other point to also take cognizance of is the fact that there's a high consumer debt level within our communities. Inflation normally averages around 4.5% to 6% per annum. So whatever you put your money in, you actually want it to either grow in line or you want it to beat inflation. And then the other thing is to note is, again, given the South African context, we also understand that unemployment rate also impacts the long-term financial planning as well. So what is saving and what is investing? So we'll start off with saving. Saving is normally short-term in its nature. It's low risk, which then yields low returns. So your returns typically range between 3 and 6%. And it typically comprises of your bank accounts, your fixed deposits, so your cash equivalent type of investments. That's typically what you use for saving. And then for investing, it's normally long-term in nature and attracts at higher risk, but then the returns are typically higher than what you would get. Say, for example, if you were in a savings account or a fixed deposit. And what you'll normally find is unit trust, a wide range of unit trusts within that segment, ETFs, including shares as well. So this graph basically just shows you the impact of saving versus investing over 20 years. Assuming you're getting a rate of 4%, 1,000 Rand over 20 years, you can see the difference between saving and investing over 20 years. That when the funds are earmarked for longer term, you actually want to be on the higher end of the risk curve as opposed to being on the lower curve when you're saving, because the end result is that significant. So it's really just to highlight that savings is good for short term, but if you have long-term goals, you actually want to be investing. And these are just the assumptions we use for the graphs, just to make a demonstration. Now, why does saving matter? So one is to build up your emergency fund. Saving will act as a safety net. In anyone's financial journey, you actually want a bucket whereby if emergencies come up, whether it's a burst tire or it's a family responsibility, whatever the emergency is, or loss of a job, this is when you typically dip into your emergency funds. So it adds financial security when unexpected expenses arise. And then also saving helps you achieve your financial goals. It's the first step. Also, in the longer term, it helps you contribute to your wealth accumulation phase, enabling you to actually invest and grow over time once you've started with the basics of having an emergency fund, defining your your financial goals as well. So the difference between short-term and long-term saving goals is short-term goals include saving for vacation, household appliances. Um, you'll save it's typically something short-term. So anything short-term is anything that could happen within a year or two. I'd even go as further as maybe even 3 years sometimes. Then your long-term goals typically focus on significant future expenses like purchasing a home, maybe building your retirement so you actually are able to retire um, at your desired retirement age, whether it's 55, 60, or 65. So it's normally essential to basically balance between your short-term savings versus and your long-term savings because the two actually work together well. So if you don't save for the short term, what you might end up finding yourself having to do is dip into your long-term savings because you haven't catered for your short-term savings. So it's always important to try and balance the two together. Now, the benefits of savings is there's four things to maybe to be mindful of. Is one, it gives you a sense of security. It's you're able to sleep better at night when you know that if anything were to happen, there's a bucket or emergency fund that is readily available for emergencies. Gives you a peace of mind as well without when life happens, you don't have to stress about where is the money going to come from, which then results in reduced financial stress and promotes a better mental health and well-being, and then also it helps you to have a positive mindset when you think about finances and also probably it has a better or positive impact when it comes to decision making. When you have things put in place, sort of like savings, budgets, and investments. When you start making financial decisions, you make them from a better place, less under pressure. So there's also a sense of clarity of mind as well. So maybe we can start off with how do we then create a personal budget? Well, one would look at maybe also looking at assessing your income and expenses. So start off by pulling your bank statements, um, looking at what comes in, understand what comes in your household. Then you look at your monthly expenses. Um, then you look at what is fixed, what is variable, see where your money is actually going. And I've often found that even with myself, whenever I look at my budget, and I normally review it on a quarterly basis. Some people review it on a monthly basis. It's up to you, but my recommendation would be you need to review it at least on a quarterly basis, maybe as a start to actually see if your budget is actually realistic. You'd probably start off by monthly just to get a better understanding of where's your money going, right? And then it gives you almost an oversight in terms of where your money is going, and then it helps you construct a proper budget once you understand where your money is going. Um, so um, when you do your budgeting, you assess your finances. Then there's this thing what we call a SMART goals framework, which means basically in your budgeting you need to be specific. So the SMART stands for specific, measurable, achievable, realistic, and timeline. So meaning your goals need to be specific, they need to be measurable, they need to be achievable, they need to be realistic, and have a timeline to ensure that your goals are clear, attainable, providing a solid foundation for success. And then you break down your goals as well, make them to smaller, manageable milestones to track progress and stay motivated. Um, and then again, to building an emergency fund. One, maybe we can start off with what is the purpose of an emergency fund? Like I previously said, it's basically to help you cater for unexpected expenses. Um, it also helps you maintain regular savings. So when you get used to actually putting money aside for that emergency fund at the start, you actually start getting into the habit of putting money aside. Um, without having to think twice about it. So when you get into the habit of it, it helps you to then get used to saving on a regular basis. But it also then helps you to prevent accumulating debt, unnecessary debt, during financial emergencies, which then brings peace of mind. Because when you don't have an emergency fund, then you are forced to dip into things like a credit card, which doesn't bode well when it isn't used well. So how much to put into an emergency fund? It varies based on your own circumstances, to be honest. The rule of thumb is anything between 3 and 6 months worth of living expenses should cover you within an emergency fund. If your job maybe isn't as stable as someone who's permanently employed, then I would even go as far as saying maybe look at putting in a bit more than 6 months worth of living expenses. And then tips for consistently contributing, and this works for me. It's one, automate your savings. If you've done your budget, now say for example, you've got 5,000 Rand left, or which is discretionary, it's variable, there's no real fixed expense attached to maybe that 5,000 Rand that's left. Maybe you put maybe 2.5 or 2,000 Rand or 1,000 Rand, and maybe place a debit order into a savings account, lock it in, whilst you get used to not seeing that amount in your account. So what it helps you with is your money's coming in, you won't need the 1,000 Rand or 2,000 Rand, whatever the amount is. It then just helps you not, when you look at your bank statement, forget to put money aside. So when you automate things, it just makes your life easier, and you'll probably think twice about dipping into your savings as well. And then maybe another point to make is when you are starting to make or start making regular contributions, rather treat your savings as a fixed expense. Prioritize it in your planning and make sure you are consistent with it. That way, when you see it as a fixed expense, you are not going to see it as something that you are going to dip into unnecessarily. So now we're going to talk about investing. So the basic principles of investing. So the first thing we need to understand is risk, right? You need to understand the first thing is that, all investments carry risk, some form of risk. Whether when you put the money in the bank, you hope that the bank won't be liquidated, and whenever you want access to your money, they'll be able to give you your money back. It's the same principle, even with investing in financial markets, or whether it's shares, ETFs, or unit trusts. There's always some sort of risk. So what typically informs how much risk you need to take is what are you trying to achieve? How long do you want to invest, which then speaks to your time horizon. And another consideration is, if you're someone who's maybe cautious or maybe a bit more moderate around, your risk profile maybe, or you want to achieve a bit more growth, diversification does help in terms of spreading your investments across asset classes to reduce risk and potential returns. So when we talk about asset classes, we're talking about shares, talking about property, bonds, and cash, basically. So now, your different types of investments come in different forms, but this is just a high level view of what are the other investments that are out there. One, if you have the money, is buying shares, and that just represents ownership in a company. And they're normally volatile, so meaning very risky, but they can offer high returns, right? So if you're someone who's never been exposed to them, so you'd actually want a more diversified portfolio where you've got shares, bonds, a bit of cash, and other asset classes. Bonds is basically debt securities where you basically give your money and in return you get a fixed interest payment based on the money put in and the yield or the coupon that the relevant bond is offering. So it's normally considered a bit safer than bonds. It also has its own risk, but normally safer or better than shares. My apologies. And then what you often find is that investors normally find it easier to invest in unit trusts. The reason being is you still have exposure to shares, but you're buying units as opposed to buying actual shares. You can even have exposure to bonds, cash equivalent investment, property, the like. So unit trusts are a nice way of actually getting diversification and exposure to various asset classes, but also managing the risk. So we'll look at balancing the risk and reward. So it's very important to balance risk and reward, right, to implement a successful strategy. Again, it boils down to your preference, your goals, but the balancing act is just as important. You need to understand what is your risk profile. What is your risk tolerance? If your portfolio or your investment is down 25% this year, would you still be able to sleep at night, given that you understand that you're not going to need the funds tomorrow? It's long term, it's for retirement. So whether it's 10 years, 25 years, 30 years, whatever the number is, um, if you feel like you cannot stomach that, then you look at then you look at a lower risk profile, whether it's a balanced risk profile where there's a balance between risk but also preservation. So you're trying to manage that risk. But then again, when you do that, then you need to be comfortable with the type of returns that you will get. The higher the risk, typically can give you higher returns, but not always the case. What it does come with it is higher volatility, meaning your portfolio could move up and down. But over the longer term, what you hope for is that you do achieve those returns. But it's not always guaranteed, like nothing in life is guaranteed. And then when you do plan for retirement, one needs to understand what are your retirement needs. Okay, so what does my lifestyle look like today, right? And what will it look like when I retire? And you look at your income, your expenses, your likely expenses that might fall off as well. So if you're paying for a bond today, and say you got the bond today, and you've got 20 years till retirement, chances are by the time you retire, the house should be paid off, right? So your bond monthly payments should fall away. So it's things like that where you start stripping away to look at what are your real expenses when you do retire, and then you look that will help you form a real sense of how much you need at retirement, but also look at potential income sources. So if if you've got savings, you've got a pension investment, then that also helps. If you have none of these things, then now would be the time to actually look at having such things in place. So if you're employed, make sure you're contributing towards your pension fund. Make sure you still have savings outside of your pension fund, and then have investments as well. That will give you optionality when you do decide to retire. Now, I've put these 4 categories under retirement saving options, but I mean, your tax-free savings account, one could look at them as a saving, but I've put it here because one, typically your tax-free savings account, you're basically, if I go into maybe a bit more detail, your annual contribution is capped at 36,000 Rand and your lifetime limit is 500,000 Rand. So meaning in your lifetime, you cannot contribute more than that, right? So typically you actually want to dip into your savings account at retirement because one, there's no tax on interest, dividends or capital gains. You can access the fund anytime. So then it provides you um, that access to funds at retirement, whether it's for, hospital bills or, you want to travel, but at least in the next 10, 20, 30 years, whatever you put in there, the growth there is tax free. And then the other point would be just when you think about retirement annuities, is basically, again, there's no tax in investment returns. You can access it from the age of 55, and any contributions you make, they're deductible contributions, obviously kept up to 27.5% per annum of your taxable income or 350,000 Rand. And the similar rules apply to your pension provident fund. Now, when we look at developing financial good habits, what the first thing to look at, to be mindful of, is try by all means to avoid debt. And where there is existing debt or credit, manage it well, right? So how do we achieve that? Firstly, it's spending within your means. So um, if you're earning 20,000 Rand a month, make sure you don't spend the entire 20,000 Rand or spend more than that. You would actually rather than have, if you'd rather, maybe best case scenario is you're earning 20, your fixed expenses are around 10. Then you've got discretion to then start saving, investing with the balance, right? And then also another thing to be mindful of, if you already have existing credits, so things like a credit card, a clothing store account, make sure you make regular repayments and try and bring that cost down. So whatever your limit is, so don't max out your credit card, don't max out your clothing store account, because it becomes a lot more harder to pay it off over time. So the less you use, the better. And then lastly, it's always great to actually maintain a good credit score. And this helps you then by making regular payments, whether it's your telephone bills, your credit cards, whatever the case is, just pay whatever you need to pay for on time, and make sure that if it's debt, you're decreasing your debt. And that should improve your credit score. And what it then helps you with is when you do need a car, when you do need to buy a house, your banks typically look at your credit score as well. It becomes a better conversation or an easier conversation when you're negotiating for things like interest rates or favorable terms, whatever it looks like in your own personal circumstances. And then another thing to consider, to be mindful of, is it's very critical to review your plan. So if you're going to review your financial plan, it's normally better if you don't have a financial advisor to do it with a financial advisor. Financial advisors or planners are there to help you construct a plan, two, help you stay on track, and then help you review and then your plans and actually check in. How are you doing? How are you tracking? Has anything changed within your life circumstances? And see if you're on track in terms of achieving your financial goals. And again, when things change, like personal circumstances or market conditions change, having someone to be with you, to walk that journey with you, actually goes a long way. And then another point to make is, when you review your financial plan, it helps you to then um, make continuous improvements. So, for example, if I start off with 500 Rand a month and maybe I got an increase or I've paid off my credit card, now I've got more capacity to save and invest. When you involve a financial advisor to say, look, I now have 1,000 Rand more, it then helps you to then put a bit more extra with your financial advisor, right? I mean, and then they can guide you where to allocate the funds. Maybe put more into savings or put more into unit trusts, and given the economic climate, they might just say maybe let's phase it in. But sometimes you need someone to actually guide you in an environment like that. And then again, what's also important is staying informed and adapting to change. Understand the world that we're living in. So what normally helps me is just reading financial news, and reading news articles to see what's happening from a geopolitical landscape, but also just in the country. It helps you take a view on things and maybe where to allocate your money. And then it helps you have better conversations with your financial planner to say, look, I read about this. What do you think about this? Should I be concerned, given I've, I'm exposed to X, Y, and Z, and they can come back and say, no, you're fine. We've actually catered for that. Or, yeah, you're right. Maybe let's look at maybe tweaking a few things. So, walking a journey with a professional does help you then, to then construct a financial plan and a financial plan that makes sense for you as an individual. So in conclusion, I think there's four things maybe if I want you to take away is it's these four things. One, I hope you understand saving, develop an effective saving strategy, which will be crucial in assuring a secure financial future for yourself and managing your expenses wisely. And a well-planned budget really helps you in tracking your expenses, maximizing savings, and contributing to your overall financial health. And again, investing is it's investing for growth, wealth, So investing wisely is key to growing your wealth over time and ensuring long-term financial stability. And lastly, developing good financial habits uh, helps you to then make better financial decisions and improves your financial security over the long term. Thank you. That's it from me. Not sure if there's any question.
Hi, Zippo. Yes, there is. I'll give you the first question. Is it better to save or use the money to pay off debt? For example, paying extra into a bond.
So I would say, depending on what your expenses look like, so it's normally better to maybe have a financial advisor walk the journey with you. But I would say rather look at paying off your bond because of the interest that you're paying, right? So the quicker you pay it off, the easier it is and quicker it is to build up your savings. But if you have no savings in place, maybe do both in conjunction. So put in a bit extra in your bond, but also start putting something aside for your savings. But I would say don't neglect putting extra into your bond, if that makes sense.
Excellent. Another question. Can I use a tax-free savings account as an emergency fund?
I would say no, because once you've dipped into say you've contributed 36,000 Rand and you've gotten to 500,000 Rand, your lifetime limit, you can't have it back again. Once it's used up, it's used up. So you typically want to use it in your retirement years or much later in your years, just so that you have that flexibility later on in life. I would say when if you can rather use something else like a fixed deposit or a savings account where you could potentially put some money aside and dip into it. And but for a tax-free savings, it's a bit it can hurt you in the long term, essentially.
Okay. Um, let's have a look if there's any more. Um, I don't. Okay. There's a comment that's saying important conversation during July Savings Month. Additionally, I would add that you want to prioritize high interest debt first while maintaining short-term and medium-term and long-term savings options. So I think in essence what the person is saying, pay off your debt with the highest interest first.
Interest, correct.
Yes, because that saves you. But then again, would you agree that once you've paid off one debt, you should use those funds to pay or to pay into the next one,
Correct.
so that
Correct.
you don't spend that bit extra that you have, but you pay that
Paid.
to pay off your next debt amount. Am I correct?
Correct. And it builds you. Then over time, you have capacity to save and invest more.
Excellent. Let's see. Oh, that's see. Okay. Somebody's asking for the presentation. Guys, the recording will be available on the FBI's YouTube channel. So you will all have access to that in about 2 to 3 weeks' time. So watch our YouTube channel for that. Let's see. How would you advise someone who had a business failure later in life and is trying to recover?
Um, can you repeat that for me? Business
Let's
failure
see.
and is trying to recover.
To recover, yes.
I would say, again, start small. Um, there is no, literally, when I started off with, I had no idea of what savings and investing is when I was in varsity. But what I started off with was if I got an allowance um, of say 1,000 rand, I'd put 100 rand aside if I could live off that. It's really just starting to build healthy financial habits with the little that you have, and hopefully with time you can also then start putting more aside.
Thank you. I think what the important thing is to start. I
Yeah.
know, um in the times that we're living, money is scarce, but we need to build up that emergency fund, because if you have an emergency and you don't have a bit of extra money, you're going to be worse off. So
Mm.
start small, maybe revisit your budget, um, and see if there is any way that you can, build up an emergency fund, whether it is for um, emergency medical treatment, or you've hit a pothole and you need to replace a tire, but anything that you have available will help you when you get into that emergency. Let's see. Somebody says, I was once told one can have more than one tax-free savings account. Will they have all the limit of 500,000?
Yep. So they're all basically, whether you have 10 or one, it actually, the limit is that
The
500,000
limit is
rand is
500,000.
doesn't, it's your
Oh,
lifetime. So whether you
is
have,
it
yeah, multiple, it doesn't change your limit.
perfect? Super, I don't see any more questions. I think what we are saying is speak to a professional They can help
Correct.
you negotiate the questions that you have, and be informed. Do some reading of your own, and make sure when you visit a professional, you can have a valuable conversation, and they can really assist you to put together a plan that will really take you into the future and give you that financial resilience in future.
Yeah,
And if there is no
absolutely.
further, sorry, Sipu, if there's no further questions, greetings from Zipu and myself, and we're looking forward to seeing you in our next webinar. Thank you, everyone. Have a great afternoon.